The biggest investing opportunity of your life. Real estate is dropping, major corporations are faltering, and the stock market appears to be in trouble. As a result, investors are selling up, fearful that the long-awaited terrible recession has arrived. It's fair to say that when it comes to financial markets, we've had reasonably easy years in the last 10 years. At the same time, the S&P 500's earnings have almost doubled while its prices have tripled. The highest federal funds rate in history was currently in effect. It only amounted to 2.5%. As a result, now is a terrific time for businesses and investors. Money has been easy to obtain, making it simple for businesses to increase values in order to develop and for investors to profit. At the end of 2019, it appears that anything you buy doubles in value quickly. But of course, the bubble burst, sending the world into chaos, with firms closing and financial markets collapse. The recession was long and gloomy and drove the financial world to its knees. That's right. In truth, the world's central banks intervened, printing trillions of dollars, distributing them to businesses and consumers, and kicking the can down the road. But now that we've caught up to them, and inflation is at 40-year highs, the game of printing money to save us is no longer viable. As we have seen, the Federal Reserve has been sharply rising interest rates, limiting citizens' and businesses' capacity to obtain money. To put it mildly, it has imposed a price on the economy and given the financial markets a headache. Cryptocurrencies have been wiped out, now finally here. But despite all this happening so far, and all that will happen over the next year or two, this could be the best time to get ahead and build wealth. So let's talk about why it is such an ample opportunity and how you can use it to your advantage. Finally, here we are. Despite everything that has happened so far, and everything that will happen in the coming year or two, this could be the perfect time to get ahead and expand your fortune. So let's talk about why this is such a great opportunity and how you may take advantage of it. It's an enthralling phenomenon, and the primary reason for this reverse loop. The psychology is that most people do not have specific investment goals. They have not committed to a long-term investment time horizon. As a result, when the news worsens and the recession arrives, they flee the prospect of short-term hardship instead of taking this tremendous opportunity. However, this is a horrible plan. Since 1926, there have been 15 recessions and 11 bear markets, for a total of 12 if the 2020 draw is included. So the bear market lasted 14.7 years. Along with that, the market has been in a bull market for 75.4 years. Consider that. These terrifying, world-ending disasters occur only occasionally. And, as you can see, if you have the guts to invest during these times, you will frequently be rewarded handsomely. Consider the following results for the Great Depression. Over 4.4 years, you earned 265%. He made 43% in 1.8 years, 210% in 4.1 years, and 908% over 14.8 years after the next bear market. And the trend continues. The table from Tony Robbins' book, Unshakable, is a good place to look. If you were the person who put your money where your mouth was at the bottom of the worst bear market in history, you would have made a 20 to 30 to 40 to 50% return just 12 months later. It was formerly impossible to pick the market bottom. In reality, you are unlikely to receive such gains. It does, however, demonstrate how valuable a bear market can be. For example, if you had invested at the market's peak before the 2020 commodity slump, you would have made around 9% on your money. However, if you decided to invest at the market's low a few weeks later, you would be up roughly 60%. That's how significant your entry point may be. And, as the youngster previously stated, these large drops are quite rare. There have been 14.7 years of bear markets and 75.4 years of bull markets. These opportunities to endure some discomfort in exchange for long-term gain are rare. It makes sense during major opportunity recessions. But how can you exploit this opportunity without making costly mistakes as an investor? The first step is to stay current on market developments. As a result, you are aware of when these possibilities arise. Step 2 is to correctly execute your approach, whether passive or active investing. As we all know, there are two main approaches to long-term investing. First, there's dollar cost averaging or long-term value investing in the Warren Buffett approach. And you know the majority of people will go with the format. They'll go with dollar cost averaging. For those who are unfamiliar with dollar cost averaging, it is essentially the process of spreading your money across the whole stock market using an index fund. SPY, for example, is the traditional S&P 500 index fund, and it is the most important index fund in the world. Dollar cost averaging, DCA, is a regular investment method that tries to use value investing principles. Benjamin Graham coined the term in his book, The Intelligent Investor. According to Graham, dollar cost averaging means simply that the practitioner invests the same amount of money in common stocks each month or quarter. In this manner, he purchases more shares when the market is low than when it is high, and he is more likely to achieve a desirable total price for all of his assets. Dollar cost averaging is also called pound cost averaging in the UK, and, irrespective of currency, unit cost averaging, incremental trading, or the cost average effect. It should not be confused with the constant dollar plan, which is a form of rebalancing investments. So, they select a market tracking investment, and then invest the same amount in that market tracking investment at regular intervals from their investors. So say $2,000 every 6 months. Your money is spread throughout the entire market via that index fund. As a result, this method is intended to remove any emotion from investment. However, it still provides the reward of the market's long-term performance, which is approximately 10% each year for the S&P 500. You don't have to worry about your money, read annual reports, or anything else. Of course, at first glance, this method does not appear to be your time in the market, specifically capitalizing on the excellent opportunity of a stock market crash. But in reality, you are because $2,000 will not purchase you as many shares when the stock market is very high. On October 9, 2007, for $2,000, you could purchase 12.78 SPY shares. However, the market crashed a year later. This meant that $2,000 would help you purchase 20.5 shares. It's brilliant. Naturally, while the price is low, you will buy more shares and much less when the price is high. You haven't had to make any changes to your investing practices. As a result, we prefer dollar cost averaging. That is the genuine way in which passive investors take the opportunity. Simply by doing what they've always done, they've caused a major market crash. However, many investors prefer greater control over their portfolios and prefer a Warren Buffett-style method of purchasing individual firms. They recognize that having competent management teams provides them with significant competitive advantages, and of course, they are the safety margin. In this video, we will quickly discuss how active investors can guarantee they are not taken advantage of when investing in this volatile economic environment. And the first thing we must consider is what is currently happening that is causing firms to suffer. And the primary issues right now are high inflation and rising interest rates, which means increased costs. Debt service costs more, and consumers are spending less. So how can you be certain that a company will survive? In such a climate, the business you're considering requires pricing power. Price power indicates that they have established a competitive position in which they can raise prices without experiencing a decline in sales. Many businesses, for example, must decrease costs when consumers spend less on discretionary things. However, firms such as Coca-Cola have significant competitive advantages. They can raise prices without experiencing a big decline in sales. In fact, despite raising prices, they boosted their drink sales by 8% and concentrated sales by 4% in Q2. And this trait is critical to success during an inflationary period. As Coca-Cola's climbs, it may easily pass those costs on to customers with no negative consequences. So that is the major feature that combats inflation. However, another important thing to consider right now is the growing interest rate. And of course, the main effect of increased interest rates is that debt refinancing becomes more expensive. So the best method to ensure that your company survives this period is to keep its debts to a minimum. For example, Google has more cash than they did equity. Although the difference is only 0.05, they make more money than they pay in interest. Meta is even better because their firm financials show no debt, making them an excellent choice. Finally, my overall concern is just considering the company concept. Is this business model resilient in tumultuous economic times? Grocery businesses, for example, often outperform recessions because consumers can't stop buying necessities. Insurance businesses and customers will cease paying for home or auto insurance simply because they are tired of cash. But on the other hand, customers have less to spend when interest rates climb. I'm familiar with travel agencies. Holiday preparations may be abandoned if the expense of living consumes more discretionary resources. There you guys, this is our coverage of why this is a chance of a lifetime in investing. Until next time, goodbye.